Hello traders and welcome back to my YouTube channel IPDATrader. Now in today's video we're going to be taking a look at one of the trades that I took using my longer term trading approach, which was in the euro dollar. We're going to be getting to know a little bit more about naked levels in this specific video, how I used to trade them, how they make for great entry points, and how we can use other naked levels in the chart as targets. So if this is something that you want to learn today, make sure you stick to the entire video because I'm going to be trying my best to present you with everything you need to know about naked levels, how I use them to frame trade ideas, and how I use them as targets as well. So without any further ado, let's dive right into today's episode of Price Action. So traders, before we get into the actual lesson of today, just a very quick word from our sponsor today, AAAFX. AAAFX is a regulated broker which has been in the industry for over 14 years, which gives you a lot of confidence when it comes to executing trades, depositing money, withdrawing funds, trading funds, as they're a very well known and very respected and established broker in the industry. They allow you to trade pretty much anything you want, including forex, indices, commodities, stocks, cryptocurrencies, and they have something that not many brokers have, which is a zero commissions account for forex pairs on ECN plus accounts. So if you're interested with them, guys, you will find the link in the description below. Use the link in my description to sign up with them, as if you do, you will be eligible for a 100% matching deposit using it, which is very, very good and not many other brokers will do. So once again, massive thank you to AAFX for sponsoring this video. And now into today's lesson. Enjoy the video. Alright traders, so here we are on the charts again. And as we said before, we're going to be taking a look at a method for high probability trades using naked levels, which will provide you with high probability opportunities. So before we dive deep into it, let's go to a slightly higher time frame and let's take a look at what has been happening with this Euro USD. First of all, we can recognize we had been in a sideways range, moving up and down, not really going anywhere, creating very visible liquidity pools on the upside as well on the downside. We then moved higher, cleared the liquidity sitting above these relative equal highs, and then started a descent. Okay, as you can see, we've been descending ever since, which once again, as we go back to the lower time frame, provides us with a clear break in market structure below the low, which then indicates that this market is overall bearish. Okay, however, what we need to understand is that even though this market is bearish, there's opportunities for both sides. You can be trading short, you can be trading long. Now, when we talk about trading shorts, it's rather simple. You want to be fibbing your high to top leg, and you want to be looking at levels above 50, and at that point you want to be denoting naked levels, POIs, as you can see over here, to denote your areas to do business at above the 50, because we want to do it at a discount. So with that being said, how do we trade this market for potential longs if it does not retrace and it rather keeps going lower? Well, this is where naked levels actually come into play. And once again, let's talk about this specific trade, which was executed right at this level, 6,929, and was taking profit right at this naked low here at 7,560. Now, the reasoning behind this trade is this naked level that you can see on the left hand side, which once again is sitting below liquidity. Okay, yes, it is true to say that this overall region is an order block, and you can say, hey, it bounced off of here, which is correct, but I like to be a little bit more precise than that. And in order to be a little bit more precise than that, we look at the individual candles. Okay, and once again, you're free to look at multiple time frames and denote the one that you deem as the most relevant one. But for me, I stuck to the 1 hour, and what I saw was this naked level here, right? If you put it on the right place, you can see there is a wick here that we've never returned into. Okay, I'm aware of this fair value gap, but I think that fair value gaps and the way that I use them in my trading is that they tend to fill most often than not. So I'm looking at this naked level here, which is this wick high that has not been tested yet. Once again, if we had this kind of action where we broke up off the wick and we came back to test it, this would have not been a naked level. Another example would be here. We would have a naked level here if it wasn't for the fact that this very next candle traded back into the wick and even lower, as you can see based on this wick, and then pushed higher. So therefore this does not become a naked level to trade, but this one over here on top does become a naked level to trade. Okay, and this is how you're going to be able to capture high probability pullbacks when the markets are trending and you're not getting that retracement that you want for your longer term trades. So the buy was executed blindly over here, right? No confirmation, nothing, just place a buy limit here, right, on this naked level with the expectation that once liquidity has been grabbed into the level, right, with this obvious trend line liquidity, swing low liquidity resting below the slow, we're going to see a movement higher. And where is it going to reach into? Well, you have multiple reasonings on why this was the target for the trade. You have highs here that function as buy side liquidity, and you have a naked level here. This bearish candle wick low, as you can see, has not been tested yet. We've not returned back into that wick to fill the candle. So this is where I'm targeting. Once again, it is crucial that you understand that if you're trading counter trend like this over here is, you're not aiming, you're not saying to yourself, hey, I'm getting long here and we're going here, right? 200 pip move. No, you're looking for the next probable area if you want to have a high probability chance of your trade actually being successful. So to map this out, we can see that I went long here with my stop loss resting below the bullish candle, this one, not the swing, because if it's going to break the floor, you want to be the one that's first out of it. Okay, you don't want to say, hey, I'm placing my stop below the swing, and as long as it does not take it, I'm still in the trade. No, you want to place your stop below the bullish candle that initiated the move up in this range, which in this case is the low coming in at 106682. And you can see was never tapped. Once again, for buy positions, you do not need to add the spread on the stop loss. So as long as price does not reach into the into my stop loss, realistically, I'm still in the trade. So I was not worried with that, right? And you can see it came pretty close. It squeezed the level a little further, but that's why you're not saying to yourself, hey, I want a 5 pip stop loss. Rather, you want to give yourself that comfort of allowing yourself for a rather bigger stop loss below the bullish candle that initiated the move, and you're going to be safe that way. And as you can see, the trade went as such. Initial drawdown right through the early hours of New York, but eventually we reach target, which is once again above the relative equal highs buy side liquidity into the naked level, because this is your next area of potential trouble where price could easily react and carrying going lower, which in that case I will be looking for the very same trade. As you can see, I've already denoted, it's a bit off right now, but we have another naked level here, another wick high, where I'm gonna be stepping in front of it. If price ends up coming lower here, I will be long here, more than likely, and I will be trading to the next level, which is going to be the next low in front of price. So what I want to see now is price aggressively push lower. If that happens and price pushes aggressively lower, I will be taking a long here, targeting any of these wicks that remain untested. Okay, could be one that trades in the future. I don't know at this point, but whatever it is that the market leaves as unmitigated wicks, naked levels, I will use that as a target, right? And I'm not gonna say, hey, we need to go up here before I take profits, because I'm looking for a high probability trade. And that's how you're going to get high probability trades. You do not need to aim for a 1 to 10. You can easily aim for 1 to 2, 1 to 3. I think this was a 1.25, and have a high probability of a successful trade, which is essentially what you want. When we look at this wick here, um, we can see that it respected the stop loss that we denoted for the trade, right? You can see the wick low is coming in a little bit lower, and that it had a perfect bounce to the next area of interest, right? So that's how you're going to achieve high probability trades. And if you look across multiple time frames, you will see that more often than not, right? That these things tend to repeat. They do happen quite frequently. I mean, I've not prepared any other example, but as you can see, I'm waiting for this naked low here, sorry, this naked wick to take another long if price were to travel down below the swing into the naked level. This one, both are valid at that point. But I just wanted to walk you through the Euro USD buy position that was executed using a little bit of reference into your overall market understanding, levels and how they form, naked wicks and how they tend to get respected and price tends to bounce off of them, and how you can use them as targets at the same time. So I really do hope that this was a valuable lesson. Once again, to summarize what has been discussed today, you want to be understanding this. Naked wicks, no tests, high probability bounce. You can trade counter trend, but aim for logical targets. And that's pretty much the lesson that I wanted to talk with you today. It's rather simple trade. It didn't require any rocket science. It was just the understanding that yes, price is pushing down and we want to be short. But before that happens, because I'm not shorting this market over here unless we return back into these levels, then I'm not stepping in front of it and I'm not taking any trades to the short side, but I can look to buy the lows, right? Because at the time that I'm buying over here, this is the low of the market of this leg. I'm happy to do that and I'm not afraid of it because I know that I have a reasoning behind it, which is going to be the naked wick on the left with the swing low liquidity being taken into it, with the trendline liquidity, and with a logical target, right? Not a stupid target which usually people throw around everywhere, which makes absolutely no sense. If you want to have high probability chance of a good trade, you need to be looking at these things over here. Okay, simple trade, simple bounce. Now, before we wrap this up, I wanted to pull the Fib tool to show you another example. Well, not example, but another idea that supports the long that was taken. If you fib the leg from low to high, you can see that the naked level that I traded lined up perfectly with a 62% retracement. So there is another reason here on why buyers may step in front of this and go long, which is exactly what happened over here, right? And traded right back into the 50, which coincidentally lined up with the wick low that I was looking to target anyways. So it made for a beautiful, perfect trade. You can see that the confluences were there. We know that we're bearish. We know that we can take longs at the lows at specific denoted price points of interest, right? And I just wanted to clarify that I will be looking for longs here. I will be looking for longs here. I'm not afraid that the market is falling into my level. That's exactly what I want to see. And these are things that you will be able to do with little to no effort, with experience and looking at the same patterns unfold over and over and over and over again. So very simple trade, which once again line up with everything that I look for to have a profitable outcome. Now, the way that price reaches into the levels is a lesson for a different day. But to give you a little bit of a information on that, the more aggressive we drop into the level, the better. You don't want to see price drifting slowly but surely into the level, creating lows that are going to be trouble for you if you do end up taking the long and price starting to push up, because this price is going to be reacting to the sets of lows. So therefore, the cleaner the move down into the level, meaning the cleaner the bearish candles that form, the better for you, because you're going to have clean range as we turn and start moving the other way. You don't want to see that slow grind into the level. You want to see it collapse into it, okay? And I know that it takes a real leap of faith to step in front of something like that, but you will get used to it the more and more that you practice it. So with that being said, I really do hope you enjoyed the lesson. I will be uploading more videos more frequently, so stay tuned for that. And we will be discussing naked levels in more depth in future videos. So take care, everybody. Thank you for listening. Leave a like if you enjoyed, and I talk to you guys very soon. Thank you for listening.